Good afternoon, ladies and gentlemen. So today we will have a webinar on how to value an enterprise for transaction purposes. Maybe we want to sell and buy enterprise or business. So how to value these properties, properties. So this is an event that organized by VFC World Council of Experts. In the world, we have VFC International, and in many countries, we have VFC, that is the International Real Estate Federation. And in India, we also have VFC in India as well. In Thailand, I'm the president of VFC Thailand. But this event is organized by the VFC World Council of Experts. We have many councils. We have Council of Developers, Council of Valuers, Council of Experts, Council of Property Managers, and Council of PropTech. So we have various councils, but this council is about experts in various fields. So we will have this case, and we organize it every month. But this month, it is an honor for us to have Dr. K Gupta, the Managing Director of ICMAI Register Valuers Organization in India. Before Dr. Gupta start, allow me to introduce a little bit about our speakers, Mr. Gupta. That is, Dr. Gupta is a postgraduate in Commerce, Go Middle East. Wow. And also FCS, FCMA, and PhD in corporate governance, with over 43 years of corporate experience in leadership position. But you still look young. But 43 years.
Thank you.
Very little depreciation.
Thank you.
With various public and private sector organizations in the domain of finance, costing, valuation, internal audit, sustainability, very important, and integrated for reporting and company secretarial function. And he has dealt with mergers and acquisition. So this is related to valuation of enterprises as well, and corporate restructuring, anti-dumping duty, and corporate governance mechanism. Currently, Dr. Gupta is the managing director of the Register Valuers Organization of the Institute of Cost Accounting of India, and he is also the chief executive officer, CEO of the ICMAI Social Auditors Organization, and chief COO of the ICMAI International Chambers. And another thing is, Dr. Gupta has chaired and addressed a large number of national and international conference seminars and in real estate, in valuation. And he has been visiting faculty at various leading business schools for over 3 decades in India and also other countries as well. And he is a member of various industry association like IBSC something. And Dr. Gupta is the editor-in-chief for various professional journals. He is also a public writer and has been written over 300 articles and research papers, a lot as well, which are regularly published in various professional accredited national and international journals. And currently, he guides 5 PhD scholars, and he has also conducted management development program, both open program and also in-house for various leading companies in India and other countries. And Dr. Gupta plays flute. How you play a musical instrument as well? Wow, great! And he has released an album of songs and bhajan played by him on flute. Wow. Maybe at the end you may demonstrate somehow for us as well. So this is Dr. Gupta, Dr. K Gupta. And today, from now, he will speak about how to value an enterprise for transaction purposes, maybe for sale and buy or accounting purposes or something. So the floor is your Dr.
Thank
Gupta.
you. Thank you,
So
sir.
please go
Thank
ahead.
you. Thank you so much, Mr. Sopum, for inviting me and giving me an opportunity of interacting with fellow professional valuers from various countries who are joining this program. Just give me a second. Let me share my presentation on the screen, please. Thank you. So, all of you would tend to agree with me that the world is changing, and the world is changing very, very significantly and rapidly. I am not only talking about the last 2.5, 3 years when the world as a whole had been impacted by COVID-19 pandemic situation the world over, but even otherwise, if you look back 2 or 3 decades, there have been some very, very significant changes which have taken place in this world, which have changed the way we live our life and also changed the way the businesses function in the marketplace. It's very different world today from what it used to be maybe about 20 years back, 30 years back. It's very different. And in terms of the business and economic environment, the world over, we commonly refer to it as VUCA world. The world today is highly volatile, very, very uncertain, hugely complex, and very ambiguous. That is the kind of business and economic environment the world over that we are experiencing and witnessing. And that makes the business and economic environment very, very challenging, very, very dynamic, but at the same time, opening up and offering a lot of good business opportunities for all of us. In this very, very volatile and dynamic business and economic environment, we have old businesses which are still surviving, still sustaining in the marketplace, but there are many old good companies which are no longer existing now. They have fallen by the wayside because possibly they could not adapt to the changing times. Xerox, Kodak, Nokia, some of the big brands of yesteryears, they just could not survive and sustain because they could not adapt to the changing times that we are witnessing in this world. Along with the old businesses, we also have side by side existing so-called new age companies or startups which are mushrooming all across the world. And some of these companies now are coming out with some very, very disruptive business models. Let me give you some examples. World's largest travel car company does not own a single car of its own. World's largest travel lodging company does not own a single hotel property. And the world's largest retailer, Amazon, does not own a single brick and mortar store. These are amazingly disruptive business models which were unheard of till about a few decades back, but these are the realities of the corporate world in 21st century. Now, when you check out performance of various companies existing in the marketplace today, you find that many businesses, many companies today, the world over, have profitless turnover. They have a great level of turnover, but there is no profit. Many companies, many businesses have this kind of a characteristic. Many companies have cashless profit. They have profit as per their financial statements, but then there is no cash, there is no liquidity. Profitless turnover, cashless profit, but when you look at their valuations, wow, soaring very, very high, skyrocketing valuations. The point that I want to focus on is today, the measures of corporate performance have undergone a change. We no longer only focus on profit or profitability. We actually look at the ability of the company to be able to create value, ability of the company to be able to preserve that value, and ability of the company to be able to enhance that value going forward on a sustainable basis. That is what the stakeholders today are looking for from the companies. And that's where value creation becomes the success mantra for all businesses in 21st century. When you create value in your business, when you create value for the stakeholders, they tend to offer higher valuation for your business or for your company. So there are various business transactions happening everywhere across the world which require valuation to be done. You have mergers happening across the world, one company acquiring the other company for extracting synergy and thus enhancing the overall valuation of the company or overall value of the company. Then there could also be a case of demerger, a company deciding to spin off part of the business or part of the assets of the company by way of a demerger. This could also be a case of acquisition, buying a business from the market, or sale of business. Valuation is also required when a company is looking for raising funding for the business. And this is important and vital, not only from the perspective of the so-called startups, but even for the well-established companies. Anytime they want to raise funding from the marketplace, valuation plays a very, very central and pivotal role. And that's a major consideration from the perspective of the financiers. Valuation is also required to be done in a transaction where the business is being split up into its various parts. So there are various situations in the business and economic environment. There are various transactions which require valuation to be carried out of the business and the company as a whole, commonly known as enterprise valuation. So whenever there is a transaction, there is a seller and there is a buyer. The sale or the transaction will happen or materialize only when the seller is satisfied that the price being offered by the buyer is not less than the value of the asset being sold, of course, as per his perception. That's because valuation is all about perception. Valuation is all about hope. Because when you're buying an asset today or you're acquiring a business today, you're buying it and acquiring it in the expectation or hope of generating good amount of profit or creating value for the stakeholders in future. So the seller will be willing to sell his business or company only when he finds that the price being offered by the buyer is not less than the value of the buyer as per the perception of the seller. So it becomes very important for the seller to determine that particular level, that particular threshold which the seller considers adequate, below which he would not like to sell his business, and therefore determination of this threshold amount, which is adequate from the seller's perspective, is the first prerequisite for conducting any business transaction. Well, yes, even though the value of an asset is determined on the concept of fair value, which is basically intrinsic value accruing from the basic fundamentals of the business or the company, but different sellers, different buyers can have different perceptions and thus different expectations with regard to the returns expected from that company which they are looking to buy today, depending upon the underlying strategic aspects or dimensions or considerations. Offer price. The price offered by a buyer is after estimation of all advantages, all benefits, value of assets and liabilities, and the synergy which is expected after acquiring a particular business from the marketplace. The buyer would offer a particular price for buying an asset depending upon his expectation and his perception of how the buying of a particular company or acquisition of a business is going to provide him benefits in terms of creating higher stakeholder value in near or long future. So we are all aware about the basic principles of valuation. Price is what you pay, value is what you get. A well-known quote by Warren Buffett. There is a well-known water diamond paradox. Water, you buy bottled water everywhere in the world. How much does it cost? Maybe $1, maybe $1.50, maybe $2, depending upon the place from where you're going to buy that water bottle. But look at the value of water. Wow. A few drops of water can save the life of a person. What is $1? What is $2? Nothing, peanuts. But when you look out, diamonds, wow. The price is very, very high, running into few thousand, even $1,000,000. But in terms of value, well, I don't know. End of the day, it's just a stone. But then, of course, it gives you value in terms of status. It gives you value in terms of snob appeal. But in real terms, the price is phenomenally higher as compared to the value provided to the acquirer for acquiring a diamond. So business value should be more than the value of simple addition of the value of various assets. That's when a transaction is going to be beneficial from the perspective of the buyer. Because it is said that it is always better to buy a good company at a fair price rather than buying a fair company at a good price. You must look for acquiring a business, acquiring a company at a price where the price is higher than the value that you are expecting to get, and the business value itself has to be higher than the simple aggregate value of the various assets of the business or the company. Then we have a very important concept in valuation that of absolute value and relative value. Valuation is relative. Value is relative. It all depends upon the perception of the person who is valuing a particular asset, and therefore one has to be careful in looking at the estimated range of value provided by a registered valuer or a valuation professional, because valuation or the value can not be absolute. It is most of the cases relative. Value can never be a precise number. That's because valuation is not only about numbers. Numbers are the starting point, but not the end point of valuation. Ultimately, value is required to be determined. Valuation is required to be done based on consideration of various factors. Some of these factors are subjective, judgmental, and therefore value cannot be a precise number. It normally falls within a particular range. Valuation involves subjectivity, yes, but it involves informed subjectivity. Even when we are subjective, while providing an estimate of value for an asset or a business, the registered valuer or the valuation professional takes an informed call. He takes a decision what value to attribute to a particular asset depending upon the information available with him, and therefore, even though valuation involves subjectivity, but it is informed subjectivity. And the deal in a transaction is always stuck at a point after negotiation between the buyer and the seller. Whatever price the seller wants to buy or wants to sell the asset, he will not get the price. Whatever price the buyer is willing to offer, he will not be able to get the asset at that price. Ultimately, it's going to be determined by the comparative bargaining powers of buyer and seller, or ultimately is going to be determined by negotiations between the buyer and the seller. So, when you buy or acquire a business or a company, it's possibly going to give you ownership over that company, either complete or partial. So, what is the extent of control that you're going to get on that company or that business which you are looking to acquire today? That will have to be adjusted in arriving at the estimate of value for that business in terms of premium for control. You're going to acquire control of a business, either a majority control or a minority control. But this element of control gives you some element of premium to be incorporated, adjusted while arriving at the estimate of value for a business. Timing is very critical. Same asset will have different value at different points in time. Any business, if you look at its valuation today and compare that with its valuation in pre-COVID in 2021 or 2020, is going to be significantly different, either on the upside or on the downside, depending upon how did COVID impact a particular business. Therefore, timing is very critical. When exactly you're valuing a particular business or an asset is critical, valuation will change in time as to when exactly a particular business or an asset is being valued. And we valuation professionals know that before we start any assignment, we must be very, very clear about the purpose of valuation. Why have I been asked to carry out valuation of a particular asset? Is it required for some regulatory measure? Is it for acquiring of a business? It is for merger, demerger, acquisition, or sale of business. We must be very, very clear with regard to the basic purpose for which valuation is required to be carried out. That gives you understanding as to what approach to follow, what techniques to apply, and what other considerations to take into account, because everything ultimately depends upon the purpose of valuation. And of course, what is being valued? If you're going to value the business as a whole, it's going to have land and building, it's also going to have plant and machinery, it's also going to have current assets and financial assets, securities, it's also going to have value enshrined by way of intangible assets. So you are looking at valuing a company or a business enterprise in totality. Or sometimes you may only be required to value a particular aspect of a business, only a particular building or a particular chunk of land owned by a particular business. Then, of course, the valuation is going to be only specific to a particular asset which you have been asked to carry out value for. The basis for valuation, commonly known as the premise of valuation, is very, very critical. Are you looking at valuing a business on a going concern basis on the assumption that the business is going to exist and survive in the marketplace for quite some time, or the premise and the basis that you are going to adopt is liquidation, that the business is not expected to be continuing in the marketplace as a going concern going forward, and therefore you are required to determine the liquidation value as if The business assets will get sold in the marketplace. How much cash, how much money do you think can be realized by selling the different assets of the business? And of course, you also look for forward cash flows. What is the ability of the company to generate future free cash flows? That's a critical aspect to consider while valuing a business when it is a going concern. Because the value of the business in that case is going to be primarily driven by the strength and the healthiness of the forward cash flows that the business is expected to generate going forward on a sustainable basis. Now, as valuers, our role is to minimize the risk of buying an economically unattractive company. Our role is both from the seller's perspective as well as for a buyer's perspective. The valuation given by a valuation professional to the buyer and also to the seller is ultimately going to be the basis of negotiations between these two parties for arriving at the final deal price or the final transaction price, and therefore valuation professional in a business transaction valuation plays a very, very important role. Value created for the acquirer, how much value the acquirer of a business will be able to create for himself, for his stakeholders. That's going to be the value received minus the price paid. How much you're paying for acquiring a business and what is the value that you think that you are going to receive for acquiring that particular business. There is a well-known case study of Tata Steel, an Indian manufacturer of steel, a big company in India, which decided to acquire a company in UK in 2007-2008, namely Chorus Steel PLC. Tata Steel was wanting to expand its footprints into the European market, and they spent about 7 months, 9 months scouting around for a target company. Finally, they zeroed in on Chorus Steel PLC. Everything was done, negotiations had happened. Finally, Tata's bid and Tata offered a price for acquiring the shares of Chorus Steel PLC. Suddenly, what happened? A company from Brazil jumped into the fray. They also showed interest in acquiring Chorus and they offered a higher bid price. Tata had spent quite a few months scouting around for a good company to acquire. They also raised the bid. Brazilian company once again increased their bid. Finally, Tata were able to acquire Chorus Steel, but at a price which was almost about 35% higher than their original bid. And the valuation of Tata Steel after the acquisition of Chorus Steel PLC never really looked up. That's because they possibly ended up paying higher than justified price for acquiring Chorus Steel. It is very important, therefore, that the acquirer must look at what is the value that he is going to receive by acquiring a company and what is the price that he is going to pay for acquiring that company. This has to be carefully assessed and carefully looked at by the acquirer of any business. So, when you decide to do a business transaction by way of acquiring or purchasing a company or a business enterprise, you have to examine and look at several aspects pertaining to the company's activity. You got to check its historical performance. How has the company been performing in the past? Of course, past performance is no guarantee of future performance of the company, but nonetheless, it will definitely provide you a lot of useful information with a view to be able to forecast the future performance of the company after you acquire it now, today. You also got to analyze the competitive positioning of the company in the industry. Is the company a market leader or is the company a very, very small player with just about maybe less than 10% market share? What is the USP of the company? What are the strengths and weaknesses of the company? What has been the operating performance over the last few years? What is the capital structure of the company? And what is the cost of capital? What is the regulatory framework within which jurisdiction the company is operating? What is the global industry outlook? If you're looking at acquiring a cement business, just check out how is the cement industry likely to perform globally, worldwide? What are the trends? What is the global industry outlook in a particular segment, say steel, say cement, any other industry for that matter? And of course, everyone today is talking about technological revolution, artificial intelligence, machine learning, blockchain, how technology is likely to impact a particular industry or a business. Very, very critical consideration to look at today while or before valuing a particular business. And then you have to look at all these factors with a view to be able to do the preliminary homework and prepare a basic blueprint as to what is the company all about in terms of nature, in terms of scale, in terms of market positioning, in terms of SWOT, strengths, opportunities, weaknesses, and threats. In order to have all this information, you will have to check out the company profile, visit the website, ask the company to provide you historical information, the background, who are the promoters, understand the business. What are the fundamental factors impacting earning potential of a particular business, as well as what are the strengths, weaknesses, opportunities, and threats of a particular business enterprise? How is the company or the business performing today? Is it doing good? Not doing good so well? Is it not working at all? It is a closed factory? Whatever. What are the business plans? You must also look at financial statements, either audited or unaudited. You must check out the control. Who is owner? Who is the controller of the company as of now in terms of shareholding pattern? And you must also check out cash flow statements and significant trends and changes in the performance of the company which have happened over the last few years. Well, you are going to value a particular business enterprise, but at the same time, in the public domain, you will have lots of information, some reports given out by market analysts, advisors. They would have given some reports, they would have given some opinions. Just check that out in a view to cross verify, corroborate whatever research you would have done yourself. It is always good to look at what other people have to say about a particular business or a company. Also, check out share purchase agreement, shareholder agreement, have discussions with the management on the various assets and liabilities, including contingent liabilities appearing in the financial statements of the company. You can't only look at the numbers reflected in the financial statements of the company. You got to check it out by having detailed discussions with the management with regard to the quality, nature, dimensions of each of the assets and liabilities which are shown and appearing in the financial statements of the company. You also have to be careful in order to be able to look at abnormal developments in the past year. If you compare the cash flow of a company for the year 21-22 and you compare that with cash flow for the year 24-25, you can't do a direct comparison. That's because in 21-22, the cash flow would have possibly been impacted by the COVID-19 situation. And today now, we are out of COVID. So you can't compare the two cash flows on an absolute basis. You will have to adopt the process of normalization of revenue and normalization of cash flows. You must carry out due diligence, whether there are some carry forward losses. You must also look at how are the other companies in the marketplace performing in the same sector, cement, steel, aluminium, power. There must be many other companies in the same jurisdiction. How are they performing? What is the CAGR, compounded annual growth rate? If you find that the industry average CAGR is about 9% and this company is performing at a CAGR of 4%, that means there is something different with this company as compared to the other companies existing in the marketplace in the same sector. And this will have to be factored in the valuation methodology approach and the techniques that you're going to follow. What is the market share of the company? What are the business barriers? How easy or how difficult is it for a new entrant to get into this business space? In other words, is it easy enough for someone to set up a new cement plant in Thailand? Or are there some government policies, some government restriction which create a kind of a barrier, makes it difficult for a new entrant to be able to start a new business in cement sector in Thailand? That's going to be a critical factor to be considered while valuing a business enterprise. And then, of course, the value of the company is going to be sum total of the tangible assets as well as intangible assets. In fact, in some of the businesses, intangible assets are going to be more important, more significant in terms of value by way of patents, copyright, trademarks, software, intellectual property, technology. These are some very, very critical aspects which will favor higher valuation for a business because of intangible assets, and therefore you must carefully look at the list of intellectual property or intangible assets, and definitely you must factor them in your overall valuation of the business enterprise. We all know that primarily there are three different valuation approaches or methodologies: asset based, earnings based, market based. Asset based valuation methodology looks at the valuation of the assets. You can possibly look at balance sheet valuation, look at what are the values of different assets as appearing and reflected in the balance sheet of the company. Or you can check out asset values based upon the cost method, replacement method, by assuming that if I were to recreate this business today, how much is it likely to cost me? That's the recreation value or the replacement cost of the various assets which are currently held by a business enterprise. But then everything in that case is going to be dependent upon and based upon the value of the assets. The next approach that we look at is the earnings approach. What is the level of earnings that can be expected to be achieved by a business enterprise going forward in both explicit period and implicit period? And for that, we got to check out the contribution, the earnings, the incremental cash flows, but more importantly, we got to look free cash. Free cash flow is the aggregate cash flow likely to be generated for a business in a particular period of time minus maintainable costs, the cost mandatorily required to be incurred for continuing to exist in the marketplace as a going concern. When you net the two off, that's how you get what is commonly known as free cash flow. And of course, you have the market-based approach to valuation, where you compare a particular business transaction with a similar transaction which possibly may have occurred, may have happened in the marketplace, maybe in the same jurisdiction. That would be much better if you can get a case within the same jurisdiction, or check out for similar kind of transaction happening in some other similar jurisdictions, where you compare the market price, you compare the company multiples, you compare the comparable transaction multiples, and try to gauge an idea how much is this company worth as compared to the valuation of a company in a transaction which happened 2 months before in the same sector, in the same jurisdiction, or possibly some other similar jurisdiction. Well, different approaches to valuation are going to throw a range of values. And then we all understand we will have to apply and use the concept of weighting. Weightage will have to be given. Weighting can be either subjective or mathematical. In subjective weighting, the weightage to be provided for the valuation arrived at by using different approaches is going to be depending upon the professional judgment of the valuation professional. In mathematical weighting, specific weights are assigned to each approach, and then finally, the weighted average estimate of value of a business enterprise is arrived at. Of course, both the methods involve subjectivity. Even when you use mathematical weighting, it's going to involve subjectivity, but that's the nature of the valuation assignment. Subjectivity is going to be there, but you only got to make sure that subjectivity is informed and based on and dependent upon certain information, certain data that you have available with you. Coming down to different techniques that we can apply for valuation in case of business transactions, when you're looking for acquiring a business enterprise, one of the common techniques that we use is the discounted cash flow analysis. This is based on the premise of going concern, assuming that the business is likely to continue in the marketplace for a long period of time. We try to forecast and estimate the future free cash flows of the business. For a certain period of time, possibly, you can be pretty sure of getting a particular level of cash flows, but beyond that particular period, probably things will become very, very hazy. So there is a concept of terminal value. Beyond a particular time period, you only look at the value as a continuum. You set a minimum threshold of cash flows which you think are going to be there on a sustainable basis going forward, even beyond the time period beyond which the forecasting becomes very, very difficult, becomes very, very hazy. After you have determined the estimates of future cash flow of a business, then you got to discount them by using an appropriate discount rate. Now, this is critical. Many a time, the cash flows are very, very sensitive, such that if you apply a 15% discount rate, the project or the proposal becomes unviable. But if you were to use a 12% discount rate, the proposal seems to be viable. Many a time, real life, we have situations where just simply by changing the weighted average cost of capital or the discount factor to be used, our decision undergoes a complete change from buy to not to buy. And then once you are able to identify an appropriate discount rate, you apply that on the estimated future cash flows and determine the present value of the future cash flows, which then gives you a basis for taking a final decision whether you would like to acquire a business enterprise at that particular value or not. Well, the DCF technology or methodology is going to be useful where the business is being transferred or acquired on a going concern basis. And it's also a useful technique to apply where the business also constitutes intangibles, brand, goodwill, marketing and distribution network, suppliers, long-term agreements, loyal customers. If there is such a kind of a scenario, I think DCF methodology is going to be a really, really useful technique to apply for valuation of a business enterprise. One thing you must be careful about that a business may have two kinds of assets. You may have core assets and non-core assets. The value of core assets which are actively deployed in the operations of the business, the cash flows pertaining to those core assets are going to be reflected in the overall cash flows of the company. But non-core assets which are not directly utilized in the operations of the company and maybe possibly treated as surplus assets, their value will not be reflected in the cash flows. So maybe you will have to do valuation of non-core assets separately and then add that value to your DCF valuation with a view to arriving at the final value of the business enterprise. But the key to applying DCF methodology is forecasting future cash flows. How do you do that? How accurate, reliable, credible your forecast is going to be? That's going to be a critical factor in determining the appropriateness of value determined on the basis of using the DCF methodology. You must look at historical performance for trend analysis. You must also check out performance of the other companies existing in the market space, same sector, same jurisdiction. You must also look out for reports of analysts, other experts, publicly available data, information. And more specifically, you must check out the growth rates. What is the CAGR? What is the EBITDA? What are the margins? What is the investment already deployed and proposed to be deployed in the business? And you also must work out certain financial ratios like return on capital, return on assets, working capital cycle, with a view to be able to appropriately estimate the future free cash flows of a business. Then only you can apply the DCF methodology. The balance sheet methodology values a business on the basis of underlying assets. This technique is to be applied in cases of companies where intangibles are not significant. Everything is tangible, mostly tangible, and the value of most of the tangible asset is reflected in the financial statements of the company or the balance sheet. So this particular methodology is to be applied where the company does not have significant intangibles. Most of the assets are tangible, reflected in the balance sheet of the company. So this method does not consider the estimated future cash flows or the earnings potential of the asset. You're looking at the value of the assets as captured, reflected in the balance sheet of the company. You're not looking at the other aspect of the earnings potential. How much earnings, how much cash flow will these assets be able to generate in future? That's not what you are actually looking at. And the market approach, you look at comparable company analysis. You compare a company with industry peers by using different parameters, maybe multiples like enterprise value to EBITDA, price to earning ratio, check out the comparative market share, check out technology and other USP, unique selling propositions, or strategic advantages that one business enjoys over the others. That will help you to validate the valuation of the target company. Of course, the market approach may also be used along with or in correspondence with the DCF valuation approach. In market valuation method, the key is to look for businesses that are comparable to the subject company for business valuation. That may sometimes be a tricky and a difficult thing to have. You must check out for companies for comparison which have similar profits. They must be in the same business space, same sector. You must check out location of those companies. You must also check out whether the products and services offered by those comparable companies are same or not, and also check out the size. Is there a reasonable comparison in terms of scale of operation, size of the two companies together? Because if you make a mistake in choosing a company for comparison which is not similar in very many different dimensions, it will not help you to arrive at an appropriate value using the market valuation technology. Another approach to valuation in case of acquisition of a business enterprise or for business transaction is the asset valuation methodology. Asset valuation methodology looks at the replacement cost, the cost of replacing the assets of the company or recreating a business as of now. If this company was to be recreated, all the assets had to be recreated, how much is it going to cost today? And therefore, it takes into account the market value of the various assets and the expenditure which will be required to be incurred by the company to be able to create the infrastructure exactly similar to that of the company which is being valued. This methodology may not be relevant in the case of valuation of a going concern. The asset valuation, nonetheless, is a good indicator in cases where there are entry barriers, where there are certain regulatory hurdles or regulatory barriers or some other kinds of competition barriers which make it difficult for a new entrant to enter into the market. In such cases, the asset valuation methodology may provide to you some very good basis for arriving at an estimate of value of a business enterprise. So, you have to also check out what is the purchase price calculation. At what price can I acquire this particular business? And for that, I will have to look out and consider the target company value, the value of the company which I am targeting to acquire, comparable company analysis, how, at what value different companies in the same space, same sector, same jurisdiction have been acquired in the past few months. But then, no two companies are going to be exactly similar. There are bound to be differences in terms of technology, scale, product, USP, intellectual properties, and therefore you must also fairly consider how much premium or possibly discount you will have to use with a view to either stepping up or stepping down the value of a particular company as compared to the value of the peer company. Finally, the value is going to be determined, the purchase price is going to be determined depending upon the negotiations between the buyer and the seller in case of a transaction and also depending upon the market conditions. And then possibly you can use some kind of a financial modeling after you have arrived at various data, information that's required for carrying out a valuation, and you have also decided to follow one particular approach or maybe two or three different approaches to be followed which are permitted by international valuation standards. We are free to use more than one valuation approach if we think that's going to be relevant in a particular case. And for that, you may definitely have to use some kind of a financial modeling with a view to arriving at estimate of value of an asset. But one important point to consider here is the element and concept of sensitivity analysis. Sensitivity analysis will provide you valuation under different scenarios. Everything ultimately is based on expectation about the future. How the future is going to play out for this particular company. What are going to be the likely future free cash flows for this company? And you can't really be sure about that because future is uncertain. Nobody can really predict that to the perfect accuracy, and therefore it's always good and better to use different scenarios by changing different assumptions and accordingly also adjust the purchase price, the synergies expected, the growth rate, and come out with possible multiple range of possible valuation outcomes. This helps you to reduce uncertainty in decision making. Your decision making with regard to the arriving of the final estimation of value for assets to be used in the case of a business transaction, the uncertainty is going to be reduced once you decide to follow the concept of sensitivity. You may also check out pro forma financial overview, how the company's financials will look after one company acquires another company, after having made adjustments for the expected synergies, interlinkages, debt and equity, after also accounting for the cost of integration. And this pro forma financial overview then will show up to you the performance of combined entity or value of the combined entity post that particular business transaction or post acquisition or merger. This is essential for assessing the overall impact of a business transaction. Thank you so much. That's where I close my formal presentation. But I'll be very happy to take a few questions or have some views from the people present here. Over to the audience. Over to Sobo sir. Thank you.
Thank you. So, thank you for your contribution
Thank you.
and your time. Indeed, actually, can Dr. Gupta can say maybe half a day or something, but we have only an hour.
Thank
So
you.
we have our colleagues from New Zealand also. Wow, New Zealand may be quite late at night now.
Wow.
Madam
Okay.
Carol Whitney and some others. So we would like to first we thank Dr. Gupta first. Give a big hand for Dr. Gupta.
Thank you.
Thank
Thank
you,
you.
thank
Thank
you,
you.
Namaskaran. So now we are open for the floor. Mr. Clayton Wade and anyone, Mr. Andian Ho, and many others who are here. If you have anything, Madam Carol Whitney from the New Zealand and some other from Mr. Gary Capcott, yes, our VFC family, Mr. Kainuma from Japan, and many others.
Yeah.
Anyone would like to ask any question or comments or something? The floor is yours, Madam.
Yeah, maybe you can add your own views about this whole concept of how to value a business in a transaction. You can also add your and provide your own perspective and views, please.
Yes, sir.
Maybe
Yeah.
not a
I have a
question.
question.
Yes,
Yes,
please.
please.
Yes, sir.
Yes, mine is more anecdotal. You've had a long and distinguished career.
Thank you.
I'm curious, what has been your most interesting valuation job in your career?
Well, in my case, the valuation, I've done about quite a few valuations, of course, but the most interesting one had been where we were to acquire a company which was in distress. It was a strategic acquisition from the management perspective. We decided to buy a company which was not at all connected with our line of business, and the company was also a company in distress. In India, we have insolvency and bankruptcy law where the companies which get into a distress are required to be restructured, attempted to be revived by following a plan which is similar to Chapter 11 under US bankruptcy law, where they call it reorganization. Similar kind of provision we also have in India, insolvency and bankruptcy law. So we looked at this particular company, the valuation seemed to be pretty okay, and we thought, well, we, by virtue of our strong credentials in the marketplace, in a different sector altogether, not in the sector for which we were acquiring this company, we thought possibly we have the ability to be able to turn around this company. And we acquired that company in pre-COVID times 2020. And the performance of this company over the period of last 5 years has been phenomenal. In all parameters, the company has been doing exceedingly well by way of strategic consideration, strategic decision, strategic action that were taken by our company post acquisition of this company, which was a company in distress at the time when we decided to acquire it.
Thank you, sir.
Thank you.
And in the past, in your experience, can you give us some example of the companies that you appraised in the past, so that we can understand what are you doing, what have you done?
Sure. So I've looked at mergers and acquisitions where in one case we were looking at a horizontal merger. I mean, the companies in the same sector, we were trying to look at companies. So in the power sector, we acquired one company because we were already there in the power sector. Again, we acquired a textile company. We were already operating in the textile sector. We also looked at conglomerate merger where we acquired a company which was from a different sector altogether, not from that particular sector, but from a different sector altogether. But I think for valuation professionals, the key is not only to look at the numbers, but to try and figure out the underlying value of the business. The underlying value is something which is, of course, going to be subjective, but by carrying out due diligence, deep due diligence, you can figure out what is the value inherent in this particular business. And that's a great service, great contribution that valuation professionals make in the business transactions.
Thank you, sir. We have a senior values and very respected person, Mr.
Yes.
Sushu Bajaj.
Yes, please.
Do you have any comment or anything to contribute, sir, Mr. Sushu Bajaj? Your microphone is muted.
Good afternoon, sir.
Your microphone is muted, Mr.
You are on
Sushu
mute, sir.
Bajaj.
You are on mute, possibly.
Mr.
Sir, not
Sushu
audible. Not
Bajaj,
audible.
we cannot hear you because your microphone is muted. You mute your microphone. Yeah. Yes. Have a look. Your microphone is muted.
Oh, sorry.
Yes.
Yeah,
Am
now
I
we're getting
audible
you.
now?
Yeah, absolutely, sir. Now we're getting you. Thank
Okay,
you.
okay. Thank you. Good afternoon to all of you
Good afternoon,
learned
sir.
people over here. Sir, Dr. Gupta, your presentation was very
Thank
nice,
you.
quite
Thank you.
informative,
Thank you.
and we all enjoyed it.
Thank you, sir.
I would have, more happy if you have given this examples with some case studies, and that would have been more
Sure. I
insightful.
think the time was the limitation. Possibly we can organize another session sometime,
Yeah, that's
depending
sure.
upon mutual
Yeah,
convenience, and possibly I can run through a few case
good.
studies here for sure. For sure.
Correct.
Okay.
Sir,
Yeah.
from your, just 1 minute more, sir. So from your experience, since you have done cases in India as well as abroad, so is there any change in the methodology of valuation in different countries, or is the same? Though
No,
the
it's
basic fundamentals may be the
absolutely,
same, but
absolutely.
uh, behavior wise or other things.
I know, I know. In outside world, more the focus is on due diligence. I mean, even
Okay.
before the work is assigned to a valuation professional, the company goes in for a due diligence of the company which is being acquired, as well as for a company which is acquiring a new business. You do due diligence from various perspectives, not only from financial perspective, legal perspective, competitive perspective, valuation perspective, and the valuation professional has access to these due diligence reports. I mean, that makes it, I won't say simpler, but it provides better information to the valuation professional to be able to actually work out his valuation estimate subsequently. Somehow in India, we don't have that practice, so much practice. Some cases we do have due diligence being carried out, reports being provided to the valuation professional, but the whole process is not so structured in a way for that matter. In terms of behavior, in some countries, the approach is more conservative. If I talk of Japan for that matter, I mean, similar countries, more or less, quite a few others as well. The approach is conservative. When you look at the range of values and you try to arrive at the estimate of values, they tend to be conservative. But in some other countries, including India, we are possibly more aggressive in looking at the future about the company about which we are going to forecast the thing. So there are nuances and differences depending upon the business and economic environment and the culture prevailing in different jurisdictions. But otherwise, essentially, the tools and techniques, the approaches are more or less the same to be used all across.
Yeah, we have to be really scrutiny. Mr. Henry, my friend, any
Yes,
contribution from you, sir?
Yes, sir. Yes, sir.
Yes, thank
you.
you very much, Dr. Gupta.
Thank you.
The lecture has been very informative and interesting.
Thank you.
But my observation is that your lecture is saying we are to do this, we are to do this. If you are to value an enterprise with all this to-do list, what is the time frame? You've not talked about the challenges of lack of information, because a company might be in distress. You may not have information that they want to sell and get out of that business line because they are not making profit. You are asking comparables. In my view, comparables become historical because at the time you are valuing the comparable you are using, it can even be like even 6 months. 6 months can become historical because of inflation and the way the foreign currency market moves. What is your view? What you are provided? What is the time frame to really value an enterprise? Thank you.
Thank you. No, I understand for business, for different business transactions, depending upon the purpose and whether that business transaction is being guided by some kind of a regulatory framework or it is a transaction between the two parties, which they have slightly maybe would have kept it open. They are willing to spend 9 months, 1 year for doing this kind of a work. Sometimes the parties may be in a hurry. They would like to possibly give the report within 7 months, or 6 weeks, 7 weeks kind of thing. So it all depends upon the purpose of valuation and also the time limit prescribed by the client, if I may use that word, or by the person who is getting the valuation done, or this could also possibly be fixed by the regulatory framework. Like in the case of valuation of distressed companies in India, under insolvency and bankruptcy law, we have a time frame. Valuation is required to be completed within about 1.5, 2 months time maximum. You get 60 days, 45 days for that matter. So there are limitations in terms of time. Depending upon the purpose and the timelines provided to you, you have to decide which is the best way of getting the required relevant information and be able to complete the assignment within the given time frame. What I have presented in my presentation is the broad overall architecture perspective of what to look for. But you are right, in most of the cases, real life, we don't have access to all the information that we would possibly like to have before carrying out valuation. That's a practical difficulty that we all face. But given the purpose of audit and the time frame that has been prescribed by the parties, you have to figure out whatever best you can do with the volume and the quality of data and information which you are able to access and you are able to get hold of.
Thank you. We have our colleagues from Vietnam, Dr. Yu Chi Ming from Taiwan.
Yes,
and
please.
anyone else? Any contribution, sir, Dr. Yu? Not yet. Okay.
No problems.
Okay. Mr. Darahim, we have some from, I see. Yeah, from Belgium also. Okay, I see. But sir, last question, sir. I'd like to ask one question is, mostly your valuation is for listed company, right? For listed company, but for small SME, small and medium enterprises, is it the data information may be really limited? So if you happen to value an SME, how can you do that because of the limited information? Any guideline, any guidance for this?
Sure. The criteria and the threshold for small and medium enterprises, it varies from country to country, jurisdiction to jurisdiction. But whatever be the case, a small and medium enterprise, by basic concept and definition, is one which is possibly not a listed company, even though in India, we allow small and medium enterprises also to get listed. There is a separate platform in our stock exchange where SME also can get listed if they are able to comply with certain basic guidelines. But here we are assuming that there is a small and medium enterprise company which is not listed. In that case, the publicly available data is not going to be there. Then the valuation will only have to be done depending upon the research work to be done by the valuation professional in terms of potential of the business from the perspective of what is the management capability, who are the promoters, what is their experience in this particular line of business, what is the quality of manpower that the company has in terms of intellectual property, what is the kind of technology that the company is using, what is the level of competition that the company faces in the marketplace, not only from SMEs, but also from large players, what is the global outlook with regard to the product which the SME is manufacturing, and what are the government regulatory practices which create some entry barriers, providing some kind of a hurdle for a new entrant to enter into a particular market space. And everything put together, ultimately, you will have to discuss with the management in detail, get to understand their mindset, get to understand their perception, their commitment level, their loyalty to the business, how committed they are to making this business a success. Based upon that, you got to figure it out what is going to be the most appropriate estimate of value for that particular business. The work is definitely more complex, more difficult as compared to the valuation of a listed company. But then you can figure it out by looking at all these different aspects and dimensions of that business. Thank you.
Thank you very much. And maybe your PowerPoint.
I will share it with you, sir. I will share it.
Kindly share. And also,
And then you can share with the
recently you sent me another paper, Perspectives on Economic Value.
Economic valuation.
Yeah, we have financial value.
Have a session some other time on that topic also. Yeah,
maybe later. But allow me to distribute your paper on
sure,
perspective on
Absolutely.
economic value. so
My
that
pleasure.
people understand economic value and financial value
My pleasure.
in the future. Yeah. Okay.
Thank you.
So
Thank
thank you very much for your time,
Thank
and
you.
thank you very much for all of our participants for today. And next time we will, for you who have been in this Zoom already, next time you have no need to request for the Zoom code or something. We will send to you directly. But
Fine,
for
fine.
those who just came, we will have
No
need you to
Thank you.
register. But
Sure,
for you
sir.
have already come, no problem. So
Thank you.
let's give a big hand
Thank
to
you. Thank
Dr.
you.
Gupta for today. Yeah,
Thank you,
namaskar.
sir. Very
Thank you very
nice.
much.
Very nice.
Yeah.
Thank you.
Take care, sir. All the best. Yeah. Thank you very much.